let's move on. Let's talk about JSW Steel then. The numbers actually were better than what we were working with, particularly from the standalone business on an EBITDA per ton basis. Mr. Jayant Acharya, the joint MD and CEO of JSW Steel, joins us. Hi, Mr. Acharya. Good morning and congratulations on a good quarter in a challenging environment. Now, since the second half is expected to be much better than what we saw in the first half, could you brief us on the price increases taken in October 2024 so far?
The last quarter was a challenging quarter with respect to the overall economic scenario globally, as well as the challenges being faced by high exports from China. So we had an influx into India because India is probably one of the few countries which is growing at a fast pace. That resulted basically in sentiments dropping and the prices dropping in India. However, post the announcement of some China stimulus package, the sentiments have improved. We have seen some international prices going up in China, which has also translated now partly into India. So in October, we were able to increase the prices of flat steel and long steel between 1,000 to 2,000 rupees per ton, which basically is we feel in a seasonally strong quarter ahead, quarter 3 and quarter 4. The demand is usually stronger, so we feel that is something which will hold up.
All right, sounding optimistic on pricing, but what about the benefit of coking coal in the past quarter? What was the savings out there, and what are you bracing for in terms of coking coal cost for the second half of this fiscal?
In the past quarter, although the price of steel fell, we were able to offset that through a cost reduction. One of the enablers was coking coal, and coking coal prices in the last quarter went down by $27 per ton, more or less as we had guided. Going forward in this quarter also, we expect coking coal prices to moderate somewhere in the range of $20 to $25.
Got it. So then that, higher pricing and lower input costs will help your spread. So we're bracing for that in the second half of the year. What about volumes? Any change in your guidance? Also, exports as a percentage of the mix has come down to 7%. Will it continue to remain soft?
Yes, I think the capex, we are seeing improvements on the ground, and that is why you see the long product prices having stabilized and going up marginally. But let's keep in mind that the price increase of long products or flat products, what's happened in October, is on a very low base, which was exited in September. The prices had come down over the last few months, and that is now coming back to, let's say, reasonable level. I would say reasonable levels at this point of time. But yes, the demand on long products is reflecting the improvement in capex spending. The second thing is with respect to the international market. As you know, the international markets have been weaker. The demand, because the economic backdrop has been weaker, geopolitical risks are more challenging. So therefore, the demand has been weaker. On top of that, China, because of a local demand issue, has exported more steel. But the good thing is that I think we have seen China production moderate over the last 2 months. It has come down to 77 to 78 million tons in August and September from a peak levels of 90 million ton plus. So that hopefully will result into lower exports as we go into the winter season. That is one. Secondly, we see that more and more countries are raising barriers because that's impacting their institutional profitabilities. We expect, we are engaging with the Indian government, and we have taken some steps in some anti-dumping actions on some products. We are engaging with the government to at least find a level playing field with respect to low-priced imports, which is coming into the export side. I think the domestic demand growth in India, which has been about 13.5% in H1, is basically reflective of a very strong demand. And this is, remember, Nigel, on the fact that the capex in the first half was slightly weaker than expected. Weather disruptions were more. In spite of that, we ended the year, September, 6 months, with about 73 million tons of demand, which is actually a very strong signal. So we could use the opportunity of, let's say, to realign our products to the domestic market and thereby, switch to more domestic. That's why we had about 93% of domestic and 7% of exports. Also, it was impacted, as I said, by a weaker international demand and lower prices in the international market as well.
Okay, got that. But your subsidiaries, both Bhushan Power Steel Limited as well as your coated division, they delivered actually a weak performance in the past quarter. Obviously, there were a couple of one-offs as well. Will they improve in the coming quarter?
Yeah, so BPSL, there were some one-offs, which, so we had a shutdown in BPSL, which was a plant shutdown. The second thing, when we started the oxygen plant, there were some delays in stabilizing the oxygen plant, so we had to procure industrial gases from outside. That resulted in higher costs. So these two had an impact on the profitability. Now that the plant is now stabilized and the capacities are fully in place, BPSL will certainly be showing better numbers as we go into the second half. As far as coated is concerned, coated, I think on a per ton basis, the EBITDAs have improved actually if you see quarter on quarter. On an absolute number also, I think basically the volumes were lower in coated, impacted by international, let's say, lesser exports. But in the H2, we expect coated numbers also to improve as the seasonal demand picks up.
All right, Mr. Acharya, so we got that about your subsidiaries, but what about the international operations? Both US as well as Europe are quite weak. Should that improve from here on?
International operations impacted again by prices, mostly, let's say in US. US, the profitabilities were negative at about $11 million odd dollars. Italian operations did still moderately okay, but again impacted, although the volumes were higher, operationally we were fine, but international prices were lower, so the profitability came down to about 6.2 million or so. In Ohio, we also had a maintenance shutdown in the month of September, which also impacted the volumes. That also resulted into a little higher losses. Going into the second half, I would say we are cautiously optimistic that Italy will improve. And I think in the US side, we see prices again having gone up. On the hot rolled coil side, plates is more or less stable. So we do expect some improved numbers with some additional volumes which will come in the H2 vis-a-vis H1.
All right, I think you pretty much answered everything on the operational performance. Let's talk about your balance sheet now. The net debt has increased. Net debt to EBITDA as well has worsened a little bit, around 3.5 times. Does this cool off in the second half of the year? And are there any plans to raise some equity?
In the H2, the volumes will be strong, driven by a strong India demand, strong seasonally second half. Our capacities have come on stream. They will go into operation in this quarter and ramp up in quarter 4. So therefore, we expect the absolute EBITDA numbers to improve. That will give us additional amounts to deleverage. The second thing is that some of the working capital which got built up because of the new facilities which came in and also because of lower exports, we expect some inventory dilution and release of working capital. We are also looking at various other options to basically look at improving our ratios. And we are quite confident that by the end of this financial years, we will see improvement in ratios. Also keep in mind that in this last quarter, where the quarter was challenging, we also did an acquisition of the Lavara coking coal mine. We also spent on capex. In the first half, we have spent about 7,850 crores on capex. The working capital also went up, and because of some inventory, which also went up, these will get diluted, as we go into the so working capital release, higher volumes, therefore higher EBITDA will help us to improve our ratios going forward.
Higher volumes, better EBITDA and working capital release. Debt comes down, but you didn't answer whether you're looking to raise some equity.
Not at this point. We are not looking at doing it at this point of time. But if the right opportunity comes, we will look at different ways of looking at a deleveraging possibility.
We'll have to keep an eye out on that. Thanks a lot, Mr. Acharya, for joining in. You're guiding for a far better showing in the second half of the year. We'll track you to most of these numbers. Wishing you all the best.